You've recently written an update report on data communications management after the release of their first quarter financial results. What were the highlights?
Thanks, Allison. For those who don't know, Data Communications Management, or DCM, it's a Canadian provider of marketing and business solutions. Revenue in the first quarter was about $129.3 million, and it was up almost 70% from $76 million in the first quarter of last year, but slightly lower than our estimate of $139 million. Revenue fell short of expectations mainly because of several projects that were delayed to later on in the year. But the company reported these projects are scheduled for delivery, so the second and third quarters should be a little more positive and accommodate some of this additional revenue. But DCM did provide some positive news, saying that they added about $1.2 million of new sales from 10 new clients and over $12 million in expansion revenue from new existing clients. So kind of their land and expand model, as well as growing some business organically. And they still maintain that they're going to grow revenue by more than 5% with organic revenue growth, including at least 60% of revenue and increase from its marketing tech solutions, which it's launching and has been rolling out over the past year. Looking at some of the metrics like gross margin, we're looking at they're trying to aim and get back to sort of a 30% gross margin. And this quarter, they hit 29%. So they're getting back to the same level from the pre-acquisition mode, which happened last year. Expenses were slightly higher this quarter than last quarter. We were expecting expenses to go down, but they said they had some one-time items in Q1 that negatively affected the expenses. But on the positive note, adjusted EBITDA is much higher. It is up over 46% to $18.7 million. So good cash flow, and it was mostly attributed to the MCC acquisition that they did. And right now, DCM has $19.8 million in the bank, and it's continuing to apply down its bank facilities. There is a strong focus on the company to have a net debt of less than 1 times adjusted EBITDA, and the company has done a good job, from a peak of $145 million in debt down to almost $78 million now after they paid down after the acquisition and with some of the sales that they've done of some of the facilities.
What was the impact on the financial analysis and valuation?
We updated our model with the recent financials to incorporate the lower Q1 revenue. We slightly lowered the 2024 overall revenue to $542 million, down from $549 million. And our adjusted EBITDA also slightly decreased to $54 million. Both of these changes slightly impacted our target price. The equal-weighted target price went down to about $6.75. And it's an equal blend of a 5-year DCF, a revenue multiple, and an EBITDA multiple. But there is no change to our buy rating.
What are your expectations for the rest of the year?
We still see that DCM should have positive positive revenue growth. In addition to the revenue from the acquisition, we believe that they still will be increasing overall revenue, and also they should have improved margins. We believe that the integration of Moore Canada Corporation, or MCC, should be completed over the next 12 months. We think that with this integration, you'll have some gross margin, profit margin improvements, as well as some overall business growth. And with this improved margins, you're going to have more free cash flow to the bottom line. So it will be better positioned to reduce its net debt, as well as potentially make other strategic acquisitions.
Where can investors find your report?
All eResearch articles and reports are available to download for free on eResearch.com.